Doing well. In today's video, let us try to form a market outlook using technical analysis and price action. And every week and every month that we repeat this process, there is no doubt that we learn something new. So let us see what we can find in the price action as it has unfolded recently. So the chart in front of me is that of Nifty 50, and the time frame that I have selected is the monthly. And without putting any indicators, we can clearly see that the market is in an uptrend. And now let us just zoom a little bit closer to the current scenario, and we will see that at this point there is no doubt that we are looking at a higher top. I'll just change this text, and this is a higher top, and of course it's the all-time high, which basically means that this higher top is the reason why we are calling it in an uptrend. Another critical level would be here, in which I would suggest that this is the higher bottom, simply because the next pivotal low is significantly lower. For example, one could argue that the real pivotal low is coming somewhere here at 15,200 and thereabouts. And this is the election low, where I will just outline it with maybe say pink color and a slightly darkish tone. This is the low that was created in the elections. So we will see that the market traded significantly higher above the low that was created last year during the national elections. And after creating a higher top, the market has pulled back since September, October, all the way till February, March. And in the last few months, we are seeing a recovery rally. And the question now becomes, does the market take out this higher top, the previous higher top of approximately 26,275, thereby creating a fresh all-time high and securing the premise that the market indeed is in an uptrend? Or would the market go below and break this higher bottom, which basically means we are looking, when we talk in terms of price action, the question is, of course, we are seeing that the market is pretty much rallying from here. I mean, it was rallying much earlier, but it is safe to say it was definitely rallying from here, and I've just marked this dark. Then we will see another price action here. And since we have placed this in an uptrend because of the higher top, we would expect something like this going forward. The real question now, of course, since the market is here, is does the market do something like this instead going forward? So these are the two scenarios that we are looking at. One of them is the break of the previous top, and the other one is the break of the previous bottom. In the event the market breaks the previous low, then we will see that on the longer time frame, after a sustained bull rally since 2020, this would form a M pattern, and if an M pattern is indeed created, then it becomes quite bearish for Nifty, because we can see that the higher top of 26,250 and a higher bottom of almost 21,250 is 5,000 points. And so from the break of this, another 5,000 points would logically be the target, giving Nifty a lower side target of approximately 16,250 here. This is the case in the event the market is to take a U-turn and break the previous low. Now the question is, what happens if it doesn't break the previous low and the market instead extends upwards? And the other question, of course, is what if it simply takes a resistance and flattens out in this range? So if it flattens out in this range, then it will continue to remain a bullish index, which is currently in a range. And if any bullish trending security gets into a range, the general hypothesis is that it will break in the direction of the previous trend. So since the previous trend is upwards, generally when the market will get into a range, the hypothesis is that it will break in the direction of the previous trend. So given that there is, let's just say, a 30% chance, I'm just speaking empirically, a 30% chance that it will break the previous high, a 30% chance that it fails to break the previous high, and another 30% chance of breaking the previous low. If we divide the price action into three parts, I believe that there is a far greater probability under any circumstances that the market will neither break the previous top nor the previous low and stay in a range. That's almost always the maximum probability. Then in the order of second, it is if indeed it goes ahead and breaks the previous top. That is the more expected outcome because the preceding trend is upward. And obviously, the least probability event is the one that we discussed earlier, that the market forms a M pattern and breaks downward, because that is to take a bet against the direction of the structure. Now, if the market ranges between this 5,000 point zone that has been marked, then of course, both longs and shorts need to be deployed in the market. But if the market trends or decides to trend, then anyone who's going purely long really stands to benefit. And so so we will look at the shorter time frames now to determine where the market is, what clues the market has given us in order to form a stronger opinion. So once again, I'll repeat: preceding trend is clearly up. The previous low formed in February is a higher bottom, and when a higher top, higher bottom is formed, the general expectation is that a new higher top will be created sooner than later. Even if it doesn't, the next set of expectation is that it will continue to range and retain this bullish bias. The least probability event would be that it would break the higher bottom, creating a M pattern. But as a trader, we have to be prepared that any of these three can happen. But we are just discussing because we are planning and preparing for subsequent trades for trades subsequently in the future. So let's just shift our time frames to a slightly lower time frame now that we have got primary assessment. So I'll just remove these lines that we have created, which were obviously created in the monthly charts. And you could see that this is what I was referring to, that this was the higher bottom which the market has sort of defended. And this clearly looks like the range that we had discussed in the monthly chart. The probability that market could trade in this particular range almost indefinitely, that is between 22,000 to 25,000, almost indefinitely, has the maximum probability. But let me just remove this for now, the readings that have been acquired from the previous chart. And since the market is in a range, that means there are inconsistent highs and lows. We have to look for the possibility of a pattern. And when we connect this low here, and then we note that there are approximately 1 2 3 4 5 6 approximately 6 to 7 candlesticks which have happened, so I think it's rotated ellipse would be better. I'll just select the figure again. So if you just can see here, and yeah, so pardon the angle of it, I'll just try to make it slightly better. But the intention to show you is that this is looking like a flag, a pole, and this is obviously the flag. Now the market is obviously in a range at this point on the weekly charts. The reason why is because it is trading below its previous all-time high, and this is more like a double top structure. But we want to form a bias on what is it likely to do, and because it's in a range, and it is only in range that markets do tend to form a pattern. And we can see that when the market has rallied the previous time up, there is a pattern that could potentially be in the making, and that looks like a flag pattern. And here if we see, the low of this pattern is at approximately 22,000. So this will be my new horizontal. I'll remove this one because we are getting closer in on we are getting closer in on the trade planning. As we move, so obviously we make a bias on the longer time frame, but as we keep going lower, we are coming closer and closer to executing a particular trade. And obviously at this point in time here would be the breakout of the flag pattern, because this would be the previous weekly high. And what has happened here is that after creating a bullish flag pattern, the market has indeed closed the week above the flag pattern. And if at all it is closing above the flag pattern, then the low of that flag will logically, I'm sorry about that, then the low of the control means I'm surprised, then the low of this flag pattern will actually be the SL, or the exit of the trade as per this. So once we have obviously used a monthly time frame to assess the general direction of the market, which looks bullish or maximum bullish range, when we come in the weekly, we identify or get closer to the range extremes, and then we note that there is definitely a pattern in play. The reason is because for a bullish flag or a bearish flag to exist, there needs to be somewhere between 3 to 7 candlesticks. and that's precisely the count that we are getting here. If the number of candlesticks exceeds 7 and goes on all the way up till say 21, then in that case the pattern becomes extremely weak. So here, if it indeed does break out from the seventh one itself, then there is a potential of a huge upside. And now when we look at, obviously we have to see that this is happening on the weekly chart. So if it takes approximately this low happened in the month of March, we are currently in the month of August, so it would have taken around 5 to 7 months to form this price action. So it will take an equal amount of time, 5 to 7 months, to meet the target of this price action. I mean, it could be sooner, but it is generally expected that it will take the same time. Now, when it comes, so we now can see a flag pattern, we can see a close above the flag pattern. So obviously we have a broader sense of what we are doing, and we now narrow down the time frame and finally come to the execution part of it, and see how we can use what we have learned in order to maybe perhaps plan a trade. So obviously this is the low high of the flag now. I mean, we can get this pink line was the line at which the breakout of the flag pattern was shown on the weekly chart, and we can see that this breakout has happened with a gap on a Monday, and this was largely because of the GST changes, the announcement on the changes on the indirect taxes in the country, which is a very strong fundamental event actually, which will definitely alter a lot of things at a fundamental level, and I will cover that perhaps sometimes later. Whenever we are trading a pattern, the low of the pattern is obviously going to be the SL, which is also something that we identified. We can see this here, that the low is at 24,300 levels. I'll just narrow down this flag a little bit so that it's more aesthetic now, because we are getting in closer, and extend this right till here. Okay. So now we can see that whatever is the we are talking about we are talking about trading a pattern, right? So when you're trading a pattern, you cannot decide the SL. All the SLs have to come from the pattern itself. Do I personally trade patterns? The answer is that I personally trade momentums, which are a subset of the pattern. So the hypothesis is that if a pattern is indeed in play, there will be a time in the market where the price action will become faster, and since I would have deployed certain momentum strategies, so I should get dragged into those trades. So inevitably I'll be a part of a pattern, but I don't extensively go and create a watch list or a filter for identifying patterns. I just I see them, and yeah, and I use them just to take an informed decision in the market in generally, and form an opinion otherwise on where I'm going to be deploying my money in the future. Any which ways, when we come back here, we see that there is the breakout. Many days have closed. We are seeing a formation of an evening star, a gap up and a clear cut close. So an evening star is formed. Now we'll have to wait for the confirmation. The pattern will certainly fail at a low of 24,300. There is no ambiguity here. So this particular value has to be the SL. This is definitely the stop loss. I'll just write down in full stop loss. So this is the stop loss. We can see that this zone here, I'll just mark it right here, and I'll just now color this in maybe blue, and I'll also color this line in blue. So we will see that this zone in blue is marking the buy zone, because this is where the breakout has actually happened. And obviously now we can zoom in further, and we will see that this entirety is a gap, right? So here we have gap support. So this is a gap support, right? So logically, if the gap support is happening at 24,700, the stop loss is happening at 24,300. So I'll just mark this here. 24,000. I'll just make it 24,250. I'll just mark this one here, stop loss. And we can see the gap support is around here, and this, in my opinion, is at around 24,750 to 24,500, or maybe 25,000. Right. I've just made them in nice long round numbers. You will see this here. I mean, obviously 25,000 is here, is too high. So it's more like 24,850 maybe, or 900. Right. So obviously this is an entire region of support, and this is an entire region of exit. And if we are going to be coming with, let's just say, a 5 to 700 point stop loss in the market, you will obviously need a minimum of 5 to 700 point target. That's like the absolute minimum that we will be going for. But typically, I means I would also go 1.5 times. That is, if I am going with a 500 point SL, I will typically be going for a 750 point or a 800 point target. There is no ambiguity. Since on the weekly charts we can see that there is this particular pole is obviously of from ranging from almost 22,000 all the way, I'm just move this, uh, from 22,000 all the way to 25,500, which basically gives us a 3,000, 3,500 point up move potential. I would, that is exactly how I would plan the trade. So now I'll just remove these unnecessary lines from this process and just keep the price action as neat and clean as possible. And remove this here. Okay, so obviously the broader trade would be a flagpole on the weekly, right? The entry would be on the gap support. Okay, because the entry is at around 24,000. I'll just mark it 24,800 just randomly. The stop loss of the trade will be at the low of the pattern, which is say 24,250, and so I'll just make this a round number 850, right? The partial target, the risk on the trade would be obviously of approximately 600 points. All right, and obviously lot is, we need minimum 2 lots, so that is 150 quantity, and 600 points on 150 quantity would roughly be 90,000 rupees. I means if this trade were taken on Nifty future as is currently, if 2 lots of it were taken on this hypothesis, you would be risking close to 90,000, and I means 1 lakh rupee or 75,000 to 1 lakh rupee is basically what you would be risking. Your partial target, obviously, in my opinion, should be 900 points, but I can understand if someone would want a 1:1 partial target, because even a 600 point move on the market is quite sizable, but that would be the intention. And the pattern target on this would obviously be close to 3,500 points. So I mean, this is coming closer to 28,000. Now, since it took Nifty 6 months to form this pattern will take, we could expect 6 months to form this. In other words, we will have to go for a 3 month future position and then roll it over in that manner. For example, today's as we are recording this, it is the month of August, and by next week, and the farthest you can buy is the October future, and by first week of September you would be able to buy the November future. So based on this analysis, we will typically be looking to enter the October future at approximately 24,850, 25,000 levels by placing a GTT order, and of course we would have a stop loss of 24,250, and we will have a pattern target, and we would have a partial target based on the math of the trade. So now the question is this a part of a mechanical or a mathematical trading system? The answer is no, because in order to be able to identify a flag and a pole, or a head and a shoulder, cup and saucer, etc., these patterns need to be there in the market, and only if these patterns are really there in the market can you actually deploy pattern trading strategies. Like I said, that because it is not predictable when a pattern will form, and if the pattern is reliable or not. I have momentum strategies because I'm a much more active trader, but certain individuals who are already employed in other streams, like they could be engineers, doctors, accountants, auditors, etc. Such individuals can actually really study patterns in great depth, because it gives you a lot of time to plan the trade, and it gives you big trades to target. So yes, obviously risking 90,000 rupees on a trade or 1 lakh rupee on a trade is quite high, but you must understand that the position that you're creating with 2 lots of Nifty is approximately 35 to 40 lakh rupee worth. So essentially, you are just risking approximately 2.5 to 3%. I mean, just it's just a 3% stop loss, but that 3% stop loss is amounting to roughly 80,000, 90,000 rupees. And a 3% stop loss is very reasonable when you're going positionally into the market. So with that, I hope you have benefited in some way. Just to wrap it up, we use the monthly to form a general hypothesis. We saw the weekly in order to check if there are any patterns, because the market was trading in a range with a bullish bias. In the weekly, we do see a pattern forming, that is the bullish flagpole pattern. And since the market is already in a range with a bullish bias, we take these bullish patterns very seriously. When we do find this bullish pattern on the weekly, we can definitely get the stop loss based on that particular pattern, which is at 24,000, anywhere between 24,000 to 24,500, depending on where the trader is comfortable. And we also get the entry, which is the clear break, which last week happened because of a gap, and the market is pretty much at the gap right now. With the information of the pattern, we can definitely plan how much we are risking at just a bare minimum of 2 lots. And in general, I believe that a trader should not be risking more than 1 to 2% of their account. In other words, to risk this approximately 80,000 to 1 lakh rupee, your account size should be close to 50 lakhs to 1 crore in order for you to be able to do this repeatedly. But yeah, but obviously not everyone can have that. And I mean, the minimum capital required to execute this trade would be approximately 6 lakh rupees. So you can take this trade on 6 lakh rupee with a 90,000 rupee SL also. But you would be risking 16% of your account on a single trade, and in that case, you really need this trade to work. Otherwise, you will certainly not be able to trade 2 lots in the future, because the margins are quite high. Anyways, I hope this process of breakdown has helped you in some way. And any if you have any suggestions or queries or comments, please feel free to mention it in the comment section below. I have also tried to teach the subject in collaboration with Upsurge, so I'll just be sharing the link of that course in the description. There I have tried to explain how I basically how I use different indicators on different time frames in order to create a system of decision making. And hopefully even that will be helpful to you all. So with that, I wish you the best. Thank you for your time. Take care.